Hi there guys, welcome to Such Is Life, a channel dedicated to exploring the mysteries and complexities of life and philosophy revolving around it. On this channel, we will delve into a variety of topics related to life and how we live it, including personal growth, relationships, and the search for meaning and purpose. Whether you are a seasoned philosopher or just starting to think about the big questions in life, we hope you will join us on this journey of discovery and self-exploration. So sit back, relax, and let's dive into the mysteries of life together. In part 1 of this video we ask AI on the philosophy of wealth creation. What is wealth creation and what options are available for one's pursuit of it? What are the risk attributes that govern these pursuits? What could be a healthy pursuit in terms of portfolio and investments? Here is what it had to say. So let's start by breaking down some key components. Its answer. Wealth creation involves acquiring assets that have the potential to grow in value over time, generating additional income through investments and other sources. These assets can include stocks, bonds, real estate, businesses, or other investment vehicles that are expected to appreciate in value, provide regular dividends or interest payments, or generate rental income. The goal of wealth creation is to increase net worth and financial stability over time, and ultimately, to achieve financial independence and security. For someone starting from ground up with no assets or savings, the prospect of wealth creation can be daunting, but with a sound strategy and discipline, wealth creation is achievable. One of the most important steps is to start saving. Even small amounts of money set aside regularly can quickly add up over time. It's also important to prioritize paying off any high-interest debt, such as credit card balances, and using the excess to divert to investments. Once savings and debt reduction are established, the next step is to gradually increase investments over time. This can be done through dollar cost averaging, where a fixed amount is invested regularly, regardless of market conditions. This approach can help reduce the impact of market volatility and provide a way to accumulate investments over time. It's important to remember that wealth creation is a long-term process, and success requires discipline, patience, and persistence. By starting with small steps and gradually increasing investments over time, someone starting from scratch can work towards building a solid foundation for long-term wealth creation. As for the types of investment itself, it depends on the risk appetite that one can stomach as a start and how involved one wants to be. As a start, for someone with a low risk appetite with little to no effort, low risk options such as treasury bonds and money market funds may be considered safe investments as they have minimal risk of default or loss of principal. Treasury bonds are issued by the US government and are considered one of the safest investments available. They generally offer lower yields compared to other types of bonds, but the trade-off is that the principal is guaranteed by the government. Over the past 30 years, the average return for treasury bonds has been approximately 2 to 3% per year. Low-risk options are typically suitable for investors who prioritize safety of principal over high returns and are willing to accept lower yields. For example, individuals nearing retirement or those who have a low tolerance for risk may choose to allocate a portion of their portfolio to these types of investments. However, these investments may not be a good option for investors who are looking to grow their wealth over a longer period of time, as their returns may not keep pace with inflation. Another strategy of investment is to have some elements of a low to medium risk appetite. For someone with this mindset, a passively managed portfolio such as investing in low-cost index funds could be a desirable option. Index funds are passively managed investment vehicles that track a market index, such as the S&P 500, and offer low fees and broad diversification. The average annual return of the S&P 500 index over the last 30 years, between 1991 to 2021, is approximately 11%. This is based on data from the S&P Dow Jones indices. There have been many studies that have compared the performance of the S&P 500 index to other investment options. One such study is the cross-section of stock returns, a review of theory and empirical evidence by Eugene F. Fama and Kenneth R. French, Journal of Economic Literature, 1992. This paper compares the performance of the S&P 500 to other investment options and found that, over the long term, a passively managed portfolio that tracks the S&P 500 outperforms actively managed portfolios in individual stocks. It is worth noting that there are other notable passive portfolio investments such as Total Stock Market Index, which is an index that tracks the performance of the entire US stock market, including small, mid, and large cap stocks. The Russell 2000 Index, which is an index, tracks the performance of small-cap companies listed in the US. The MSCI World Index, which tracks the performance of large and mid-cap companies in 23 developed markets across the world, while the MSCI Emerging Markets Index is an index that tracks the performance of large and mid-cap companies in emerging markets. Bloomberg Commodity Index, on the hand, is an index that tracks the performance of commodities such as energy, precious metals, industrial metals, and agricultural products. And finally, the Real Estate Investment Trusts, REITs, which is a portfolio of real estate assets, such as commercial properties and residential housing, that can be invested in through index funds or exchange-traded funds, ETFs. For someone with a high-risk appetite, however, high-risk investments such as individual stocks, emerging market stocks, high-yield bonds and cryptocurrency carry the potential for higher returns but also come with greater volatility and risk. The average returns for these types of investments can vary widely and depend on multiple factors such as market conditions, individual performance and economic conditions. Examples of high-risk investments include individual stocks of high-growth companies, emerging market stock indices, and high-yield bonds issued by companies with lower credit ratings. These types of investments may be suitable for investors with a higher risk tolerance and a longer investment horizon, as well as a willingness to weather market volatility. Cryptocurrency is another example of a high-risk investment that has seen significant growth in recent years. Bitcoin and other cryptocurrencies have experienced large price swings and have been subject to market volatility. Over the past 10 years, some cryptocurrencies have seen significant returns, while others have lost a significant amount of value. That being said, cryptocurrency investing is often considered suitable for investors with a higher risk tolerance and a longer investment horizon, as well as a willingness to weather market volatility. It is important to note that the cryptocurrency market is largely unregulated and subject to large price swings, making it a high-risk investment option. Another form of investment is on real estate for many, as it offers potential for appreciation, regular income through rent, and the ability to physically touch and see the investment. However, like any investment, there are both benefits and limitations to consider. Real estate can be a complex and time-consuming investment, as it often requires extensive research, due diligence, and ongoing management. It also has higher barriers to entry, as real estate investments often require a larger initial investment and a more hands-on approach compared to passively managed funds. Additionally, real estate markets can be volatile and subject to market cycles and economic changes, making it important to consider the level of risk one is comfortable with before investing in this asset class. Despite these challenges, real estate has proven to be a successful long-term investment for many and may be considered as part of a diversified portfolio. So, knowing what we know about the different asset class for investment avenues, do we have a direct comparison of the returns for each asset class over a period of time to make an informed guess? Well, it can vary greatly depending on various factors such as market conditions, economic cycles, and geopolitical events. Additionally, the returns of each asset class can also be influenced by individual factors such as risk tolerance, investment horizon, and portfolio diversification. There have been numerous studies and research that analyze the performance of different asset classes such as stocks, bonds, real estate, commodities, for example gold, silver, etc., and cryptocurrencies. Some of the notable research studies include Ibbotson and Associates Stocks, Bonds, Bills, and Inflation, SBBI, Yearbook, which has been tracking the performance of various asset classes for several decades. Its conclusion is that stocks have historically produced the highest returns over long-term time periods, while bonds have generally been less volatile and provided a more stable return. The World Gold Council's Gold Demand Trends report concludes that gold has been a solid performer as an investment asset class, with strong demand and consistent price movements over time. It highlights the unique qualities of gold as a hedge against economic and geopolitical uncertainty, and its role in diversifying portfolios. For crypto enthusiasts, Blockchain Capital's State of the Crypto report is a good read as it provides an overview of the performance and trends of cryptocurrencies. The report highlights market capitalization, trading volumes, and adoption trends, and provides insights into the current state of the cryptocurrency market. These studies provide a wealth of information on the performance of different asset classes over time, and can be useful resources for investors looking to make informed investment decisions. But bear in mind that past performance is not indicative of future results, and no asset class can guarantee a certain level of return. Additionally, most of the reports on certain classes have an associated human bias, and it is more important to consider your own personal financial goals and risk tolerance when deciding on the best investment strategy for you. Okay, perhaps the narrative out there can be fit to any story. Can we then say there is an optimal allocation of low risk, low to medium risk, and high risk investments? Sort of a golden ratio of investments, as it were. As a general rule of thumb, a healthy portfolio is often considered to have a mix of low risk, low to medium risk, and high risk investments, with a greater allocation of low risk investments as the investor nears their financial goal and/or nearing the end of the career. In other words, as they become less risk tolerant, a healthy portfolio should shift mostly to low risk investment. There isn't a one-size-fits-all answer to what the golden percentage of wealth creation is, as it varies greatly based on individual circumstances. Research has shown, however, that a diversified portfolio of low risk, low to medium risk, and high risk investments over a long-term investment horizon can lead to better returns and reduced risk compared to a portfolio that is heavily weighted towards high risk investments. It is advisable to consult a financial advisor to determine the appropriate mix of low risk, low to medium risk, and high risk investments for a given individual's financial goals, risk tolerance, and investment time horizon. So there you go, folks, at the end of part 1 of wealth creation. Stay tuned for part 2, where we explore challenges of markets, typically mentality to have to navigate market turmoil or during bullish sentiments, how to build upon successes, and much more. Thanks for joining us on Such Is Life channel for this brief thought experiment. We hope that you have enjoyed exploring the mysteries and complexities of life and philosophy with us. Remember, life is a journey of self-discovery and personal growth, and there is always more to learn and discover. We encourage you to continue thinking deeply about the big questions in life and to seek out new experiences and perspectives that can help you to grow and evolve. We look forward to sharing more insights and ideas with you on future episodes of Such Is Life. If you like the content, we would love to hear your comments below, and remember to have a healthy discussion so we all can benefit together. We would appreciate it if you could share, like, and subscribe, and turn on the notification bell to be updated with our upcoming thought-provoking discussions on this channel. Until next time, take care and keep exploring the mysteries of life.